Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Let's invite our market master for the morning. Saurabh Mukherjea of Ambit Capital joins us now. Good morning, Saurabh. Well, I'm sure you've seen other instances of markets losing suddenly so much. But will it take a long time now to recover its mojo?
I think there is the short-term technical factor to contend with, which is LTCG. I think between now and the year end, we are grappling with the complications that LTCG creates. But I'm not that pessimistic about next year. We've been saying for a while now, I think for the best part of the last 12 months, that markets are fully valued. So with that proviso that I don't see the overall market having upside, I think on the macro front, we've been very constructive over the last 4 or 5 months. And Latha, I think the signs are pretty clear. We are seeing a fairly concerted recovery come through, whether it's in bank credit, whether it's in cement demand, auto demand. So the economy clearly is recovering. And my reckoning is it'll probably take the summer before the mood changes away from the concerns around the bond market, the concerns around LTCG. I think by summer, hopefully, with the index at more sensible levels, we should see a resumption in more optimism vis-a-vis the stock market. But the economy clearly is recovering. The stock market's overvalued, and hopefully, between now and the year end, that overvaluation gets sort of cleansed out of the system.
Saurabh, good morning. The joke doing the round is that the LTCG has impacted the global markets as well. That day was the peak for a lot of markets, US market also. Your sense of what's happened to the global asset classes, global equity markets, and are we going to go through a bit of a rough year within a bull market, a bit of a down year?
It could well be that we have a rough year. Again, just like India, the global economy is also seeing a concerted recovery. I was just watching that you guys were flashing the US economy hitting 3.5% unemployment rate, which is, I think, a decadal high. Japan's at full employment, Germany's at full employment. So with the global economy steaming along, and it looks as if what's happened is across the world, including India, we have preempted the recovery by buying ahead of the recovery. And hence a pause and a correction of, say, as much as 15% will sort of balance things again and put us on a good footing to then rise with the economy. We've sort of second-guessed the economic recovery too much, and therefore a cleansing is necessary. In our country, LTCG could be the trigger for that, and in America, the 10-year bond deal ripping through could be the trigger for that correction.
Okay, Saurabh, hi, good morning. As they say, the great time or best time to buy is when there's fear in the market, right? And there is fear right now. You've written this book called Coffee Can Investing. So I think we can show the book to our viewers as well. There it is. And it's the low-risk road to stupendous wealth. That looks mouth-watering. I mean, is there anything like low risk, and how do you get to stupendous wealth, right? So tell us, what do you do in a market like this, and how do you pick stocks?
Sure. So what we've been telling our clients for the last 4 or 5 years, I think, on this program itself, I think I must have repeated this mantra several times, that buy high-quality names and sit patiently on them. And the Coffee Can Investing really is about that. Buy companies which are consistently growing at a decent clip with sensible ROCs and sit tight. And what you typically see in India is, if you do this, you typically get around 10x in 10 years, which is why I say stupendous wealth. I think 10x in 10 years, by my definition, is pretty good going, which is around 24-25% compounding. And I think that mantra holds just as much today as it did a year ago. But the proviso is patience. If you're buying the Indian market today, when the market is in the near term fully valued, you've got to be patient. But let's take a few examples. CASA-funded banks in our country. There are several banks where CASA is nearly 50%. The economy is recovering. CASA-funded banks will benefit from the recovery. Some of the CASA-funded banks are at 4 times price to book, but there are others at nearly 1 times price to book. So a straightforward way to capitalize on what is clearly an ongoing recovery will be buy sensibly run banks and then sit patiently, rather than sort of gyrating with the market on a weekly basis.
But what is your definition of good companies?
Right.
Because things look good now. Like graphite looked very good a year ago. All the way for the last 10 months. So what would you call a good company?
So I think what has alarmed me over the last 12 months is there's been a lot of buying of companies which are clearly not good. They're neither good in terms of sustainable earnings performance, nor good from an accounting perspective. So good in our definition, the simple definition of Coffee Can is, if you can grow revenues in India at least 10% for 10 consecutive years, with a return on capital employed of 15%, you are right up there. You're sort of, this is not nirvana in our country. Unfortunately or fortunately, only 17, 18 companies pull it off. Okay. But systematically, you buy those 17, 18, you tend to get 10x in 10 years in the decade that typically follows. Now, do we have plenty of companies in India who pull off 10% revenue growth and 15% ROC? No, we don't. It's around a dozen and a half. But using that construct, you can even buy smaller cap stocks, which have, I'd say, a good 5-6 years of sensible growth, clean accounting. And the interesting thing is those stocks haven't run up nearly as much as the stocks with weaker accounting and shady fundamentals. And that was, I think, the really alarming part about October, November, December. Really shady companies were rocketing through on high volumes.
Okay, you said...
Just 1 second, Sonia. Just want to point out a couple of stocks where we are seeing massive surge now. I think SRF now is really your stock of the moment. Good numbers from the company and, of course, in a good sector, and now the stock is up.
They've announced an expansion as well.
Exactly, announced an expansion as well. I think I was reading a couple of reports as well, positive commentary. So that stock right now is up about 5.5%, looking good. Of course, Cipla has been doing well through the morning, so that also is looking quite good. I just wanted to complete that point you were making, about LTCG, but the budget was beyond LTCG, right? There was this clear shift about political budget. Judge Minister on record said that, this year budget has to be looked at the fact that, we are going into an election year. There's maybe probability of advancing general elections as well, though FM has denied that. But do you think politics could be a bit of a risk for the market from here on?
I think, Anuj, you're right that that the budget has sort of a little bit more fiscal slippage than most of us would like. But that being said, we expected it. And in the context of Indian politics and the Indian context of 5-year cycles in our country, I think this sort of fiscal slippage in a pre-election year is par for the course. I think barring the LTCG, the rest of the budget, I think, was broadly along expected lines.
Okay. I wanted to, you said 10x in 10 years. It looks like a pretty good growth. I mean, it looks exceptional, right? I was going through your book in which you've put a period of 2004 to 2014 when some of these stocks in your portfolio gave you about 30% or 33% per annum absolute returns.
Yeah.
These are stocks like Infosys, Hero MotoCorp, Cipla, Container Corp, HDFC, etc. But some of these industries have changed a lot since then. IT, for example, pharma, for example. Does this structure still hold for some of these good quality companies?
So I think you're right. So the identity of the winners does change as the Indian economy evolves. So for example, over the last couple of years, the coffee can portfolio has had companies from the building materials sector. So I think there's a pipe company which consistently shows up in the coffee can portfolio. This year, we added a mid-cap pharma company which has now shown 10 years of super numbers. So the identity of the winners changes a little bit year to year. So between year T and T+1, the portfolio will change by around 20%. But over a 10-year interregnum, if you stick to this mantra over 10 years, you tend to get around that 24-25% compounded mark, which is the 10x in 10 years. So yes, the metrics that we are using, 10% revenue growth and ROC, itself are doing the job for you of helping you adjust to the changes in the country. So maybe IT services has had its sort of high noon, but it looks like aspirational consumption, discretionary consumption is going to have a bumper decade. And gradually these filters that we use pull more aspirational consumption stocks into your portfolio and you prosper with a growing economy.
You said something like autopilot. Like in 2010, you sat with balance sheets, did your Excel on, say, 1,000 companies for 2000 to 2010. In 2011, you do it from 2001 to 2011. So those that don't make their appearance, you start pushing out?
That's right. So it is as close to
so
autopilot.
You renew it.
Yeah, that's right. So basically what we're doing is every year when the annual reports come out around autumn, so year end is March, you wait till autumn when all the annual reports are out and you rebalance basis the preceding 10 years of financial numbers. And what you're trying to avoid, which is I suppose the biggest sin of my profession, what you're trying to avoid is forecasting. You're not trying to forecast EPS growth and our return on capital employed. You're simply looking at the last 10 years of performance and saying, let me choose companies which are robust in their 10-year performance and buy them. And if I hold them long enough, the entry price becomes irrelevant in terms of long-term performance, right? So you're buying high-quality companies and letting the long-term compounding do the magic for you.
Okay, but then it's all a numbers game. You're not putting in points for corporate governance, guys who are not coming to the capital market too often. Those are all reflected in the numbers. You don't put anything
Absolutely.
else.
So I think in large and mid-cap investing, you're right, absolutely right, Lata. In large and mid-cap investing, we're doing exactly that. We're saying let's be as rigid as possible about the numbers. Let's not be subjective about about the last 10 years of financial performance. However, in smaller cap stocks, where the 10 years of performance sometimes is not there, right? In case of recent IPOs, you don't have the 10 years of performance. There you do have to be a little bit more subjective. And in the book, I've explained an alternative framework. I've given a separate framework for small cap investing, which is necessarily a little bit more subjective. But in both frameworks, what you're trying to do is avoid companies where the accounting is shady and where the corporate governance might be questionable, because those, I think, are the biggest stress points. And typically in sort of times like last week or the current juncture, your biggest risk is on weak companies with shady fundamentals. You lose 50-60% in the space of 6 days, and that's very hard to then pull back. It's very hard to pull back from that.
Okay. Just a point on the current market setup. We have the January mutual fund inflow number, which is lower than December. This market has been driven by domestic flows. We've again started to see a lot of FI outflows. Does this market run a risk of large redemptions domestically as well? And with the fact that FIs are pulling out, is this market a bit vulnerable over the next 2 or 3 month period?
I think, John, fortunately, flows in our country tend to be a function of 12-month lagging returns. So clearly, if returns conk off for, say, the next 2-3 months, flows will taper off. But I think what we are banking on is, given the underlying juice, the underlying strength in the economy, by summer, the market could look attractive again. And once you see that, once sensible valuations return, I'm 100% confident FIs will return. All my discussions with our FI clients over the last 3 months has been clients telling us how expensive India is and how worried they are about valuations. If those valuations normalize, the FI investor will return by hordes through the summer.
You said 15%, things can correct 15%.
Yeah.
We've already done some 6-7% from recent highs.
So somewhere around Sensex 30,000 is, I think, where fair value lies for the FI18 end. For FI18 end, 30,000 makes sense. Somewhere, basically, the current level of the Sensex is, we have jumped ahead by a year. We have baked in the economic recovery so much that we have jumped ahead by a year. And I think we need to normalize back to somewhere around Sensex 30,000 for the market to be fairly valued.
Okay, a quick comment from your end on the technology space, because I heard you mention it briefly, but it's made a big comeback. You think it's worth buying now?
So we've been plugging it pretty firmly for the last 6 months. I think on every opportunity you've given me, I've said buy large cap IT stocks. And I think the biggest encouragement we're getting that there is more juice is, as our IT analyst put it, Trump seems to have fallen in love with Indian IT, or at least he seems to have stopped hating Indian IT, which is a big tick. And the second is the Western economic recovery, which I think is now pretty firmly established, will lead to better order flows, better business for the IT services firms, especially in financial services. As those economies boom, you'll get more business. So on both the regulatory front and on business flows, I think there's good news ahead for the IT services companies.
Okay.